Yeah, yeah. Good evening, everyone. Thank you for taking time out on a Saturday afternoon. My name is Manish Garg and I'm SVP and Head Investment Insurance for Wealth Business in India for HSBC India. Before we welcome our esteemed guest today, I would like to set the tone for this webinar. The Union Budget is one of the most anticipated event in the calendar year, though this time it was an interim budget, given we have general elections due in next 2 months. However, this budget sets a tone for government's policy, which they will speak about during the general election. Today, our speaker today is Mr. Nilesha, who's the most stalwart speaker in the financial services industry at this point, and needs no introduction. So, without much ado, I would like to hand over to Nilesh Bhai for his views on the budget, his views on the economy, his views on the markets. Over to you, Nilesh Bhai.
Thank you, Manish Bhai. Very good afternoon to all of you. If we look at our economy in a lighter vein, it looks like as if we have some sort of divine help. If I had information that Israel Hamas will be at war, Russia Ukraine will continue to be at loggerheads, Red Sea supply chain will be disturbed, I would have assumed that oil prices will be in triple digit. On top of it, if I had information that Saudi-led OPEC and Russia-led non-OPEC will curtail oil production by 4 million barrels, I would have doubled down saying that oil prices will be in triple digit. And yet, with some divine help, oil prices remain between $75 to $80, giving huge support to Indian economy. There was fear that US Fed will continue to raise interest rates. higher for longer was the norm. Today, since last almost 2 months, we are seeing Fed saying that we have probably reached peak of our interest rates this cycle. And depending upon data, we will see when to cut interest rates. Probably US Fed rate are on their way down in second half of 2024. Again, it helps our capital market and FPI, FDI flows if global interest rates are declining. Third was about our growth. Most analysts in street were expecting growth numbers at 6% handle, 6.1, 6.2, 6.5. And RBI has now projected 7% growth for FY24 as well as FY25. This will make India one of the fastest growing major economy in the world. A lot of credit should go to the work done. But in a world which is slowing down, this kind of growth truly appears divine. There is one more angle of divinity. There is a story of Birbal and Akbar, where Akbar asks Birbal to make a line bigger without touching it. And Birbal draws a small line to ensure that line above looks bigger. Something that is getting repeated with India. We are doing well with oil prices low, with growth recovering, with global interest rates likely to decline. But other countries who are our peers are not doing as well. Because they are not doing as well, our growth looks bigger and brighter to investors. Today, since Russia invaded Ukraine, foreigners have stopped investing in Russia due to sanctions. China has announced his design on Taiwan. It's creating concern for global investors to invest in both China as well as Taiwan. Brazil looks very, very attractive from investment point of view, like China, but they have a communist government which cautions investors. South Africa is cheap, but they have social strife and large power cuts and infrastructure issue. Turkey, Egypt kind of countries are witnessing rapid currency decline. Net net, many of our peers are doing badly, and which is where we look better than what we are actually doing from a global context point of view. All these things have supported Indian economy, but at the same time, it has pushed our markets to trade at a premium to rest of the peers. Russia trades at 3 times trailing earning. We trade at about 23 times trailing earning. China trades at about 8 times trailing earning. We trade 3 times more expensive to them. Brazil, South Africa are low double-digit trailing earning. We are twice of them. Essentially, Indian market is now, let's say, Rohit Sharma or Virat Kohli equivalent, where people expect them to score century, hit fours and sixes, and dominate the bowling. This budget also carried same burden of expectation. Finance Minister did try to play down expectations by saying that this is interim budget and we are not going to make any announcement. But the roadmap she has laid for future budget and probably next few years, is reassuring to investors. Today, Indian economy faces two challenges. One, the rural consumption is not growing as fast as urban consumption. Mass market products are not sold as fast as the premium products. Bottom of half consumption is not growing as fast as top of the pyramid. Second challenge is that private sector capital investment is not growing as fast as the government capital investment. Net net, our economy's growth is driven more by services, government's investment or spending, and agriculture. This year, monsoon has been below average. From severe deficiency in August, it has come marginally below average in September, but it is still below average. That's going to put pressure on agriculture growth. That shortfall or slowness has to be recovered from consumption, which is growing in low single digit, and private sector investment. This budget lays the foundation for the same. It's continuing with some of the subsidies like free food for 80 crore Indians, similar allocation on Manrega, some support for fisheries, oilseeds kind of items, essentially trying to create opportunities for bottom of the pyramid. It is also trying to support private sector investment. One, the government continues to play on front foot for infrastructure investment. This year, against the budgeted estimate of 10 lakh crore, we will spend 9,50,000 crore in revised estimate. And next year, it will grow by 17% on revised estimate to 11,11,000 crore. This will continue to build infrastructure which will make India competitive and result into more new capex. The government, if it spends too much of money to support consumption or infrastructure, runs the risk of fiscal profligacy. We spend more than what we are earning. It is important for India to pursue the path of fiscal prudence. Pre-COVID, our combined deficit was about 6% of GDP. Post-COVID, it touched almost 9.5%. In the central itself, with state, it exceeded double digit. And now we are trying to bring it down towards mid-single digit. By doing this, government's borrowing program gets reduced and there will be enough credit available in banking system to fund private sector investment. Investment obviously doesn't happen only on money. Money is necessary, but you need ease of doing investment as well. That's work in progress. In few states like Tamil Nadu, Maharashtra, Gujarat, Uttar Pradesh, Karnataka, Telangana, doing business is much more easier than, let's say, some of the other states. Net, finance minister presented a trinity of impossible by creating inclusive growth, by increasing allocation for infrastructure investment, and by pursuing the path of fiscal prudence. There is some divinity here also. We had levied cess on GST of rupees 1 lakh 20, which will collect about 1 lakh 25,000 crore in FY25. Earlier, that was used with state. Now it will be available for redemption of those bonds which were issued to compensate states. This usage of GST compensation cess to retire old debt will result into net borrowing program of central government marginally below current year. This will leave room in banking sector to fund credit need of private sector. Combined private sector and consumption can move higher and fill the void left by agriculture. Put together, has the budget given reassurance to investor that India will follow prudent policy to manage its economy and to grow its economy? Answer is undoubtedly yes. Debt market cheered the budget by lowering yields between 10 to 12 basis points. Equity market didn't rejoice much on the day of the vote on account. But yesterday we did witness some positive rally. What is most important is how do we go forward from here? One criteria, we have to do well undoubtedly as we are burdened with expectations. But to some extent, others also should do badly. That helps us in maintaining our premium valuation. I can take a call that we will do well, but how do I take a call that others will do badly? What if tomorrow in Russia, a pro-Western president comes into power? People will sell India to go to Russia, which is 8 times less expensive to India. We trade at 24 times, they trade at 3 times. If tomorrow President Xi Jinping becomes more business friendly, drops Taiwan, then certainly people would like to go to China, which is available at 1/3 of India's valuation. So we'll have to see not only how we do, but also how others are doing, as that has an implication on foreigners' investment in India, and most importantly, our valuation. We believe we will do well. It's anyway difficult to take a call on whether peers will continue to do badly or not. The second is the delivery on expectations of the market. We have no option but to deliver based on the market expectations. Our earnings growth should be better than the peer group. If we look at December 23 quarterly result, real estate, pharma, oil marketing company, energy company, cement, and two-wheeler automobile firms have delivered results which are in line or better than expectations. Construction companies, some of the banks, most of the consumer durable and consumer staple companies have given results which are below expectation. IT has disappointed investors. Net market earnings is in line or ahead of investors' expectation. But within that, some sectors have done well, others have done badly. Are we on course to achieve about 1100 to 1150 earning per share for FY 2025? Looks quite likely. The second thing which we have to watch out is geopolitical events. As of today, despite worries in Middle East and Europe, we haven't seen material impact on the global markets. Can things turn around as US starts more active interest in war with strikes in Jordan, Syria, Iraq? Can this war escalate? Can traffic in Middle East, which provides us oil, gets disrupted? All those geopolitical events will have an influence on our market. Hopefully, they'll all be temporary rather than long-term damaging. Between geopolitical events and corporate earnings, there will be many events which markets have not yet discounted and could have impact on market, but in our opinion, they will all be temporary speed breaker equivalent events, not U-turn events. Sectorally, we believe large cap will narrow gap vis-a-vis mid and small cap. Normally, small and mid cap trade below large cap valuation, but thanks to a lot of flows, now small and mid caps trade at a premium to large cap. We believe this gap will narrow down in the days to come. And hence, our recommendation is be marginally overweight large cap and be marginally underweight small and mid cap. It's marginal overweight, underweight, not absolute overweight, underweight. Sectorally, we believe real estate, pharma, cement kind of sectors will do well. Consumer staples and consumer durables continue to remain under pressure. Power sector looks very attractive as Indian thermal power plants are today running at 81% PLF. It's unlikely that we'll be able to push it further higher. That being the case, merchant power rate will go higher and benefit power companies. These are the sectors: real estate, pharma, cement, power, which should do well in the days to come. Sectors which are worth to be cautious are consumer staples, consumer durables, and some of the construction companies. In the broad market, there are few pockets where one should exercise utmost caution. One is SME exchange IPOs. It's trading at twice the valuation of Nifty. Generally, at this kind of valuation, underlying companies will have to be like Hercules, lifting heavy weights, or the investor should have much, much lower return expectation. There is also few counters where floating stock is limited and concentrated, and hence valuations have run up quite sharply. As and when divestment supply begins, sustaining that valuation will become a challenge. So we'll request investors to avoid or to go with utmost caution in small and medium exchange IPOs, low floating stock counters. On the fixed income side, while yields have come down by 10 to 12 basis points, we believe there is room to go further down. March 25 10-year yield is likely to be 0.5% lower than March 24 yield. This drop in yield will be driven by global central banks cutting rates, which we expect to start from second half of 24. It will be driven by debt FPIs buying, which will begin from June 24 to March 25. This downward movement in interest rate, benchmark interest rate, is worth cashing by investing in the longest maturity possible. 30-year, 40-year, 50-year gilt will give you not only higher coupon, but also capital appreciation when interest rates come down towards end of 24. Gold continues to remain attractively poised. It is now getting flows from central bankers around the world who want to diversify into gold. And also gold prices should benefit if US interest rate comes down as we expect in second half of 24. Net net, if I have to summarize, markets had put expectations on finance minister's vote on account, by and large by creating an inclusive growth, investing for future with higher allocation on investments, and by pursuing the path of fiscal prudence. Finance minister has delivered to the expectations and more of the market. Valuations are obviously at premium to peer group. That means it's time to be neutral weight to equity with marginal overweight to large cap and marginal underweight to small and mid cap. Utmost caution should be exercised in low floating stock counters or SME exchange kind of counters. In fixed income, go for the longest possible maturity, as we believe exit 24-25 interest rates will be lower than today's level. And on gold, do increase some allocation as central banks' demand around the world will keep supporting gold prices. With this, Manish Bhai, I will end my talk, but happy to take questions.
Sure, sure. Thanks, Naresh bhai, for your wonderful insights as always. So obviously we will invite questions from audience, but before that, I will start with some of our Q&As. So Naresh bhai, budget has laid down quite a broad-ranging initiatives. But in your view, what are the most core sectors? How they will get impacted with this budget, and how do you see those sectors panning out? So core economy sectors in next 12 months.
So my feeling is that the core economy sectors of cement,
Mm.
steel, power will benefit from this budget on account of enhanced allocation. The priority of spending will be on roads, railways, water, and in all these things, cement, steel, and other metals will get consumed. Our feeling is that this budget is positive for core industries and they have a future outside of budget as well. Cement, as you know, can't be imported much because of the bulky nature. Oil, anyway, we have to import as we don't produce. But put together, clearly core industries will be beneficial from this budget.
Got it. And since you talked about interest rates, and it was largely cheered, the entire borrowing calendar and the lower estimates on borrowing was cheered by GSEC markets. How do you see impact on banks, which are already rates are pretty high for banks because credit growth is at all-time high. However, deposit rates are not that high, and there is a risk, there is a mismatch between the credit growth and the borrowing growth at this point. So how do you think that that the rate cuts as they start will help banking sector, and how what will be the impact of this on the banking sector?
So, Manish Bhai, the simple equation is
Mm.
as interest rates move,
Mm.
if that results into widening of net interest margin, it is beneficial for banks.
Mhm.
And if it contracts net interest margin, generally it is adverse for banks.
Yeah.
What we have seen, when interest rates decline, deposit gets repriced faster and loans get repriced
So,
slower. We expect in second half of 24 global interest rates to come down
mhm.
and RBI to act probably end of 24, beginning of 25. This will mean that somewhere in 2024-25, banks will reprice their deposit rates lower and loan rates will take some time to come down. That being the case, net interest margin could expand. Second, falling interest rate also results into treasury gains for banks. Combined with treasury gains and higher NIMs, banks will do well. Today, one challenge for bank is very, very tight liquidity. Both central and state governments combined have 3.5 lakh crore worth of cash balance. That's liquidity drain for the banking system. We believe liquidity will improve with FX flows. Liquidity will improve with debt FPI flows. And average interest rates in FY25 will be lower than last year.
And but you pointed out that you are expecting RBI to cut rates only by end of 24 or early 25, whereas most of the bond market participants think that the RBI may start cutting this year itself. So why would you have a very divergent view on that?
So, not a divergent view.
Hmm.
I believe Fed, which was earlier supposed to cut rates by March 24, may begin in June.
Hmm.
And RBI will wait and watch how other central bankers behave. Is Fed on course to cut rates reasonably? And after evaluating that and local data on inflation, they may take a call to cut rates either in end 24, beginning Jan Feb 25. So I'm not very different from the street in terms of direction, but magnitude, who knows?
Hmm.
Timing, who knows?
Hmm.
But it makes sense to go and buy longest duration paper. The downside is that you may have some mark to market for a while, or your expected return may be more back ended than you have expected. But
Yeah.
will you make money in a falling interest rate environment on the longest maturity paper? Answer is unequivocally yes.
Hmm. Got it. So, in your view, what is the which asset class is offering a better risk reward at this point? Is it fixed income or is it equity or is it asset allocation is a better strategy at this point?
Manish, by this year, I still believe you'll have to be present across all assets. In the hindsight, we will know fixed income has done well, or equity has done well, or gold has done well. But today, we believe the gap in their return will be far more narrower, and you are likely to get better post-tax return in equity, but that comes with higher risk. Between debt and gold, there's nothing much to choose from a post-tax point of view.
Hmm.
So my recommendation will be, Manish, by what you have been doing at HSBC forever, focus on asset allocation. If equity markets correct, you can look to increase your equity allocation.
Hmm.
If small and mid cap narrows down their valuation gap with large cap, then probably one can look at small and mid caps. If Fed prepones interest rate, instead of April, they give us, instead of June, they give us surprise in April, then yes, we can go longer duration quickly. But net, some amount of flexibility with a focus on asset allocation will be the best strategy.
Got, got. And Nilesh bhai, what's your view on manufacturing as a segment? Government introduced PLI scheme to promote manufacturing, which is some sectors have seen a boost, like iPhones are getting manufactured here. A lot of other manufacturing has shifted from China to us. But from a long-term point of view, what's your view on the manufacturing as a sector? And do you think that we can really ready to play out that China plus one strategy?
So, Manish bhai, as I said, there is some divinity for India. Suddenly, thanks to China-Taiwan challenge and COVID, the world is looking to diversify out of China as a preferred supplier. And mind you, China is miles ahead of others in productivity and competitiveness. But when there is a push, no matter what cost advantage China is giving, I need to diversify my supply chain, then people will experiment. India today has a lower productivity and lower infrastructure compared to many peers like Korea, Taiwan, Vietnam, Mexico, Indonesia, Singapore, Malaysia. But what all of them don't have is a large domestic market. We have large domestic market. Companies which become part of global supply chain thanks to China plus one, and which are leader in local market, accessing covering domestic consumers, should have laddu in both the hands. We believe manufacturing will do well, but it is not carte blanche. It is specific whether you are competitive or not. I'll give you a few examples which shows that Indian manufacturing is coming of age. We have invested in an explosive company based out of Western Maharashtra, based out of Eastern Maharashtra. They are exporting explosives to many countries abroad, including Sweden, which is the home of Dr. Alfred Nobel, pioneer of explosive. I heard about a company which is unlisted in North Karnataka. From a small town, they are suppliers to Airbus, giving them rivets. A company whose IPO recently came out makes CNG machine, which are 30-40% cheaper than peers, and yet so competitive that even Apple wants to buy them. There is a company again in southern Karnataka where they have got contract for making spare part for Toyota engine. It's the first company worldwide to get a contract to make engine spare part for Toyota. No Japanese, German, American, Chinese, Korean company has got that contract. Limited point, manufacturing will do well, but within that, you have to go and pick up companies which will have some edge in terms of research, technology, cost competitiveness.
Yeah. Nilesh bhai, what's your view on the defense as a sector? So defense capex was about 9% higher for this financial year. However, the local manufacturing capabilities have also increased, and some of these companies have run up like 600%, 700%. Do you think that it's still a very, very large scope for these companies to grow, given that India's defense budgets will really not go anywhere?
So Manish bhai, from a business point of view, if you look at defense sector, I have no doubt that it will continue to grow. One, the government has created large list of items which can only be bought locally, and it's some 120 plus items. that will give opportunity to domestic defense companies. Second, these defense companies can also become exporter. If your own military is not buying your product, the neighbors or the peers' military is unlikely to buy it from you. But when they realize that you are preferred supplier to your own government, then maybe there
mm,
is better chances of success in the exports market. So business point of view, local and global, thanks to government policies, should do well. The real challenge for us is that at current valuation, are these investments justifiable or not? There are few defense companies where floating stock is limited and hence valuations are little higher.
mm,
There we need to exercise some caution.
mm.
Other than that, I think defense will continue to do well.
Okay. So Nilesh bhai, then I will come to renewable energy. So a lot of the discussion is being around renewable energy, and government has also launched a lot of initiatives now around renewable energy, especially that e-bus seva, green hydrogen mission, 10 million households, solarization of 10 million households. How do you see that sector to pan out? Because still the lot of material which is required to manufacture EV cars come from China. A lot of these solar panels comes from China. How do you think that some of these manufacturing can shift to India, and how India will shape up this entire sustainable energy space?
So, Manish bhai, you'll have to pardon our ignorance.
Okay.
Today, on sustainable stroke green energy,
Mm,
multiple options are available. One is wind energy.
mm,
My feeling is that India has probably explored a lot of its wind energy capacity,
mm,
and hence we are unlikely to see material investment going into wind unless
mm,
until technology changes. The second is hydro
mm,
stroke nuclear kind of energy.
mm,
Few years back, nuclear energy was a dirty word. Today, it is considered green energy.
mm.
God knows whether it will remain there or not, but
Yeah.
for the time being, nuclear, hydro,
Mm,
solar are all renewable energy. Now, there is a clip circulating which says that India will be creating one nuclear reactor every year from here onwards.
mm,
We must understand that we have limitation on fuel.
mm,
While we have enough thorium, we don't have enough uranium.
mm,
On solar side, while there is sunlight available across most parts of India 365 days a year, bearing few months of monsoon, the challenge is storage of solar energy. During daytime, energy demand is low, power demand is low. At night, it reaches peak, but
mm,
solar energy will have to be stored for that.
mm,
There is also research being done on green hydrogen,
mm,
whereby you do electrolysis of water to separate hydrogen and oxygen and use hydrogen to provide alternate energy. It's not yet commercially viable, but many companies are claiming that they will soon reach there. While all these things are happening, there is also a very differentiated research coming out. In one laboratory in US, they have created sun,
mm,
a technology which produces more energy than what it consumes. In a lighter vein, In the Spider-Man movie, what Dr. Octopus tried to create sun equivalent is now happening in reality. It is through nuclear fusion, where you bond two atoms to create energy. We are master of nuclear fission, where we separate atoms to create energy. Now we are trying to master fusion, where we bond two atoms to create energy. Be the case as it may be, there is a platform called Singularity which believes this technology will become commercial, and by 2030 power will be available free. Now who knows whether this will be right or wrong?
Yeah.
My limited point, Manish Bhai, is that we don't know enough about the future to take a call on the shape of clean energy.
Yeah.
We need to invest across the value chain and hope that we'll be able to capture some portion.
Yeah. Thank you. So Naresh bhai, next would be on, we are getting a lot of questions on PSU company valuations. Obviously, some of the PSU companies are very well placed, but some of the companies have run up very, very high. So what's your view on the PSUs, and specifically on some of the underweights like PSU banks, which have run up very high, and some of the PSUs which are very, very expensively priced at this point?
So, Manish Bhai, one, undoubtedly, this is a miraculous rally in PSUs.
Hmm.
From about 15 odd lakh market cap, now they have become 50 lakh crore market cap. PSU market cap is almost as much as entire India's mutual fund industry. And 60% of that is owned by government, and only 40% is with investors. Now, within PSUs, there are PSUs like oil marketing companies where investors are cautious because they are not able to price their petrol, diesel at market prices. When oil prices go higher, they sell it at a loss. And they try to make it when oil prices go down, and they don't bring down prices. But this decision is taken by government, not by them. Hence, they command at a lower valuation. Tomorrow, if this policy changes and they get the power to price their product, the stocks will be multi-bagger. Extreme of this is some of the low floating counters in PSU, defense, railway. Floating stock is 5, 10, 15% of total market cap. It's in the hands of few people. Government is unwilling to do divestment. They were happy to sell Muscat Dock at 200, not happy to sell it at 2000 rupee, which is resulting into concentrated holding, resulting into higher prices. My feeling is that any PSU where floating stock is limited and valuation is sky high, it is time to take profit. Maybe you will curse me because after you're selling, prices will still go up.
Yeah.
But over a period of time, I believe there's no point in buying expensive stocks simply because their floating stock was limited and their holding was held by few people. Eventually, divestment will happen, supply will come, and prices will come back to reasonableness.
Got it. And specific views on PSU banks, how do they look to you right now?
In PSU banks, one will have to be bottom-up oriented. Undoubtedly, today PSU banks have large liability franchise. The CD ratio is below 100, unlike many private banks who have above 100. And as RBI reduces CD ratio, it's going to benefit PSU bank. So I do believe rally in PSU banks may continue for a while, but we'll have to pick up right PSU bank. One thing, Manish Bhai, in the next generation, how many people open accounts in PSU bank will determine whether they'll attract clients or not, whether they'll attract customers on which they can make money or not. So for the time being, we are positive on PSU bank. on a select basis.
Hmm.
Eventually, we think it's time to take profit out of PSU banks which are trading above their historical averages.
Hmm. Got it. Got it. So I'll take my last question now. So, what's your view on how elections will fare, and how what will there be a run up to the election? Will Are you expecting a rally, or what's your expectation from the entire bit on the election, upcoming elections?
So, Manish bhai, generally we have seen in election year as government spends money, markets do well.
Hmm.
Generally,
Hmm.
this year is election year. Hopefully, history will repeat itself. But every rule has an exception.
Hmm.
If you look at last four cycles of election, in 2019, market started discounting Modi Sarkar 2 like
Hmm.
it is discounting today Modi
Yeah.
Sarkar 3.
Yeah.
And just ahead of election,
Hmm.
there was concern whether we will achieve this or not.
Hmm.
Markets corrected about 10-12%.
Hmm.
And before results came out, market also got convinced that no, Modi Sarkar 2 is coming, and
Hmm.
it recovered all the losses.
Hmm.
So there was a rally well ahead of election based on expectation, then a small correction and recovery well before the election itself on the basis of confirmation.
Hmm. Hmm.
We believe we are witnessing almost similar pattern in 2024. Markets have run up from 18,000 to 22,000 nearly.
Hmm.
And this growth is driven by expectation of Modi Sarkar 3.
Hmm.
If there is a shock to that assumption, obviously markets will correct.
Hmm.
If there is concern on certainty of that outcome, then also markets can correct.
Hmm.
2014, we saw markets going one way up from September 13 as market was very, very cheap. Post-election, when it saw Modi Sarkar coming with majority, which was not expected by the market,
Hmm.
market went further up and then consolidated. So a lot
Hmm.
of pre-election rally gave you the return.
Hmm.
2009, thanks to global crisis, markets had corrected big time. There was no certainty about UPA2 coming to power. So it bottomed out ahead of election.
Hmm.
But the big jump of 20% came on the result day when they saw UPA coming with higher seats.
Hmm. Got it.
2004 was exactly opposite.
Hmm.
Markets corrected when NDA Sarkar did not come back to power.
Hmm.
Put all these things together, my limited point is markets have no special intelligence to forecast election result.
Hmm.
It takes intelligent calculated guess.
Hmm.
Sometimes it goes right, sometimes it goes wrong. But post election, after a while, markets go back to its fundamental.
Hmm.
Our feeling is that we are more like in 2019 scenario, markets running up in expectation of Modi Sarkar 3 coming to power. Any
Hmm.
shock over there will result into deeper correction. Any
Hmm.
surprise over there may result into some sort of a spike, but eventually it will taper off.
Got it. Got it. Thank you, Nilesh bhai, for taking time out on a Saturday afternoon and take us through some very, very good insights. I'm sure our viewers would have some very good takeaways from today's session. So, with that, I would like to close the session. Thank you all for joining us today and have a very good evening. Thank you, Nilesh bhai, once again.
Thank you.
Thank you.